Somewhere between now and the next few months, or perhaps the next few years, a letter is going to arrive. It will come from Genworth Financial, or Transamerica, or Bankers Life, and it will inform you that the long-term care insurance premium you or your loved one has been paying for 10, 15, or 20 years is increasing. The letter will give you a deadline. It will describe your options in language that makes it sound like you have two of them. You do not have two options. You have significantly more than that. The companies writing those letters know it, and most policyholders never find out until it is too late to use that information. Long-term care insurance was sold to millions of American families beginning in the 1980s and 90s as a guaranteed protection against the catastrophic cost of nursing home and memory care. Genworth Financial, headquartered in Richmond, Virginia, is now the nation's largest long-term care insurance carrier. In 2023, Genworth's chief executive, Thomas McInerney, received $9.8 million in total compensation. $3.2 million of that was incentive pay, tied in part to what the company's own Securities and Exchange Commission filings call LTC in-force rate actions. That phrase means approved premium increases. The person signing your rate hike letter is paid more when more rate hikes are approved. By the end of this video, you will know the 9 things your long-term care insurer is legally required to offer you and is betting you will never ask for, including one option that could protect tens of thousands of dollars in benefits you have already paid for at no additional cost to you. Between 2019 and 2024, more than 17,000 Connecticut policyholders received Genworth rate increases of 50% or more, according to a January 2025 investigation by the CT Mirror. One group of Genworth policyholders in 2022 saw average increases of 97% across a single policy cohort. Some individual policyholders in that cohort received increases of 173%. When Genworth requested a 161% increase from Massachusetts regulators, the state called it unjust, unfair, and inequitable. Genworth sued the state of Massachusetts. The rate increases are not random. Between 2020 and 2023, 3 federal class action lawsuits filed in the Eastern District of Virginia in Richmond alleged the same core pattern. Scochin versus Genworth, final approval November 2020, covering Choice 1 long-term care policies. Halcombe versus Genworth, preliminary approval August 2021, covering PCS1 and PCS2 policies. Haney versus Genworth, case number 322CV00055, final approval February 15, 2023, covering Choice 2, Choice 2.1, and California policy forms. All 3 cases alleged that Genworth had known as early as 2012 that it faced a massive hole in its long-term care claims reserves, that it built multi-year rate increase schedules into its financial projections, and that it did not disclose those plans to policyholders who were making binding coverage decisions based on what they were being told at the time. Genworth ran the financial modeling. They calculated what the reserves required. They built the rate escalation into the executive compensation structure. They wrote all of that down in filings with the Securities and Exchange Commission. That is not negligence. That is architecture. The paid-up policy option is the piece of this that most policyholders never hear about. Every state in the country requires long-term care insurers, in most circumstances, to offer at least 3 choices when premiums are raised. Pay the new premium and keep current coverage, reduce your benefits to keep the premium stable, or stop paying entirely and receive what is called a paid-up policy. A paid-up policy is a fully guaranteed benefit equal, in most cases, to the total amount of premiums you have ever paid into the policy. A policyholder who has paid $80,000 in premiums over 20 years and receives a paid-up policy now has $80,000 in long-term care coverage permanently with no additional payments required, ever. The insurer does not volunteer this. The letter does not lead with it. Most policyholders who lapse their coverage because they cannot afford the increase never knew the paid-up option existed. The structural implosion of the long-term care insurance industry is the context behind every rate letter being mailed right now. Approximately 100 companies sold standalone long-term care insurance policies in 2002. By 2025, that market had contracted to fewer than 20 active carriers, with only a handful of companies still selling traditional standalone policies to new buyers. The surviving carriers, including Genworth in Richmond, Transamerica, headquartered in Cedar Rapids, Iowa, and Bankers Life, operated by C&O Financial Group out of Carmel, Indiana, are all managing legacy policy books priced on longevity and interest rate assumptions that proved catastrophically wrong. Premium increases are the primary tool these carriers are using to remain solvent. Policyholders who do not know what they are owed absorb every dollar of that adjustment. Before we move to what you can actually do with this, if this channel's approach to how the elder care and senior living industry operates is something your family needs right now, this is what this channel publishes. Every investigation covers something the industry would prefer your family found out after the deadline rather than before it. If you have a loved one who holds one of these policies, subscribing ensures the next one reaches you in time to use it. I have looked at a lot of these rate increase letters, and the option that appears least prominently in almost all of them is the one with the most financial value for the policyholder. The paid-up option, the benefit reduction option, the right to request a full rate history from your state's insurance commissioner, and the right to file a formal complaint that can legally block a rate increase from taking effect. These are not obscure protections buried in obscure regulations. They are required disclosures. The industry's bet is not that these options do not exist. The bet is that the letter arrives, the deadline creates pressure, and the policyholder responds without making a single phone call to find out what else they are owed. The 3 Genworth class action settlements each required the company to provide special election letters to class members. Those letters were required to include information about Genworth's future rate increase plans and the full range of options available. If you hold a Genworth Choice 1 policy and have not received your election materials from the Scochin settlement, contact the settlement administrator at longtermcareinsurancesettlement.com. If you hold a PCS 1 or PCS 2 policy and have not heard from the Halcom settlement, the administrator site is pcs-longtermcareinsurancesettlement.com. If you hold a Choice 2, Choice 2.1, or California CADE, reprice, or unbundled policy, the Haney settlement site is choice2longtermcareinsurancesettlement.com. 3 separate settlements, 3 separate classes, 3 separate sets of rights that Genworth is required by court order to honor. That is not an accident of regulation. That is the proof that the information asymmetry in this market is intentional and documentable. Everything before this point is what your long-term care insurer is hoping you process in the 48 hours after the rate letter arrives, under deadline pressure, without making a single call. What follows is what changes the outcome. When you receive a premium increase notice, before you respond and before the election deadline passes, call your insurer directly and ask, in those words, for a written description of every available election option, including the reduced benefit option and the paid-up policy option. Do this before signing or returning anything. Time required, 1 phone call, approximately 20 minutes. Cost, none. What this prevents: lapsing a policy with tens of thousands of dollars in earned benefit value you did not know you were walking away from. Second, request your policy's complete rate increase history from your state's insurance department. Every rate increase applied to your policy form required state regulatory approval and is a matter of public record. Go to your state's Department of Insurance website and search for long-term care rate filings, or call the Consumer Services line directly. Time required, 1 to 2 hours. Cost, none. What this does: tells you whether the increases you received were approved as filed, reduced by regulators, or whether your state has any cap in place. Third, if you hold any Genworth long-term care policy, identify which policy form you have and check the appropriate settlement website. Choice 1 policyholders go to longtermcareinsurancesettlement.com. PCS1 and PCS2 policyholders go to PCSLongtermCareInsuranceSettlement.com. Choice 2, Choice 2.1, and California CADE, reprice or unbundled policyholders go to Choice 2, LongtermCareInsuranceSettlement.com. Time required, 30 minutes. Cost, none. What this protects: your right to information the company is legally obligated to provide under 3 separate federal court orders. Fourth, if you believe a rate increase is excessive, file a formal complaint with your state insurance commissioner. Massachusetts regulators used exactly this process to reject Genworth's 161% request. Find your state's insurance department at the National Association of Insurance Commissioners website and file a formal complaint. Regulatory pressure has resulted in multiple rate increase rejections across multiple states. Time required, 1 to 2 hours. Cost, none. Fifth, before lapsing any long-term care policy due to cost, contact your State Health Insurance Assistance Program, known as SHIP, at shiphelp.org. SHIP counselors provide free, unbiased guidance to Medicare-eligible individuals and their families. A SHIP counselor can evaluate whether the paid-up option makes the policy worth preserving, even if full premiums are no longer manageable. Time required, 1 appointment. Cost, none. The total time investment for this protocol is approximately 4 to 6 hours. The average value of a long-term care insurance paid-up policy for a policyholder who has paid premiums for 15 or more years is between $40,000 and $120,000 in protected benefit. That is the spread between knowing your options and not knowing them. Before this video, you were someone who received a rate increase letter and assumed the only question was whether you could afford to pay it. You are now someone who knows the paid-up option exists, knows 3 separate class action settlements created enforceable disclosure rights for Genworth policyholders, knows how to request your full rate history from public records, and knows that regulators have the power to reject increases that are excessive. If you are currently navigating any of this, or if something in what you just heard matched a situation you are already inside, share it in the comments, because you are not the only one and your experience is evidence. Every video on this channel is built around one principle: your family deserves to know how this system actually works before you are inside it. Subscribe so the next investigation reaches you in time to use it.